Good evening, everyone. I'm Dribjot, and it's a pleasure to welcome you to today's session on key trends in ESOP valuation. I'm joined by my colleague, Mr. Kashish, and together we'll take you through the key insights and recent developments in this space. We have packed a lot of practical takeaways into this hour, and I'm sure you'll find it valuable. Before we get into the details, let me give you a quick sense of what today's session is all about. Now, many of you have already been attending our earlier webinars where we have covered fundamental of ESOP valuations, things like valuation models, key assumptions, accounting treatment. If not, those sessions are available on our YouTube channel for you to revisit. Now, today's focus is different. This session is not about revisiting the basics, but rather about understanding what has been the trend in over the past few years in case of share-based payments. Over the past few years, we have seen some clear trends in ESOP valuation, such as one of the key challenges we have observed in the recent year is how companies handle corporate actions. Events like stock splits, bonus issues, cancellations, or settlements are often carried out at the legal or corporate level without carefully assessing what they mean for the share based payment plans. The problem is these actions directly impact option terms, expense recognition, and ultimately the financial statements. When such adjustments are skipped or incorrectly applied, it raises red flag for the auditors and regulators. This is why we are seeing much greater attention on whether companies are properly analyzing the downstream impact of these corporate actions on their share-based payment schemes. Now, another area where we have seen a significant focus is on the classification of awards, whether they are truly equity settled or cash settled. At first glance, this may look like a technical distinction, but the impact is huge. If an award is equity settled, expenses are recognized over the vesting period without remeasurement. That is, once determined on grant date, we will not have to remeasure it. But if it is cash settled, the liability has to be remeasured at every reporting date until settlement. Now, misclassifying the award means the expenses reported in the financials can be completely off the mark. That's why regulators and auditors are increasingly probing companies on the exact nature of settlement and whether the accounting aligns with the plan terms and actual practices. Now, the third one is volatility, which is one of the most sensitive assumption in valuing share-based payments schemes. Now, in the past, many companies relied on universal volatility figure. This is one figure they have taken it for, say, for example, 50% they are taking for all the all the companies. Often taking data from, and often what they do is they take data from their peer companies or some broader market indices. But the approach is no longer acceptable. Auditors and regulators now expect volatility to be justified specifically for each company based on its own trading history, if listed, market conditions, and if unlisted, say peer comparisons. Using a generic assumption without evidence can significantly distort the fair value and expense recognition. So company specific analysis of volatility has moved from being a good practice to a clear requirement in the eyes of the auditors and the regulators. A trend we can't ignore is the wave of startups preparing for IPOs. Now, in this environment, every number in the financial statement is under the spotlight, and ESOP accounting is no exception. Investor, analysts, regulators want to be assured that expenses linked to share-based payments are accurate, transparent, compliant with standards. Any errors in the valuation or accounting treatment can directly affect investor confidence and the success of the IPO. That's why startups in particular are facing much sharper scrutiny of their ESOP practices compared to a few years ago. Therefore, today we have structured this webinar around five key themes, starting with a brief introduction to the share-based payment. Next, we will look about the corporate actions such as stock splits, bonuses, mergers, or buybacks, and how these events affect the outstanding ESOPs. This is an area where companies often make errors, so we will highlight what to watch for. Next up is change in settlement type, wherein we'll cover what happens when the company decide to change the way awards are settled. For example, moving from equity settlement to cash settlement or vice versa. We will look at the accounting treatment and the common pitfalls. We'll also discuss modification situation where the terms of the plan has changed after the grant date, and here we will see how incremental fair value comes into play and what it means in the expense recognition. And after that, we'll move on to the how surrender, cancellation, settlement are handled. Companies sometimes repurchase vested options or cancel the unvested ones, and this has both accounting and disclosure implications. Finally, we'll close with one of the most critical valuation input, which is the volatility assumption. This is especially relevant in today's market condition, and we'll discuss what trend we have seen and what auditors expect. I'm confident by the end of this session, you'll have a clear view of both the technical requirements and the practical insights to avoid the pitfall. So let's get started. Now, let me quickly set the context before we dive into the technicalities. Share-based payment plans are a way for companies to reward employees by giving them a stake in the business, usually in the form of stock options, RSU, or other equity instruments. The logic is simple. If the share price goes up, employee benefits with the higher compensation. If share price falls, their benefit is lower. So effectively, ESOPs aligns the interest of employees and shareholders that and employees get motivated to think like an owner. And why do companies give ESOPs? At the core, it's about attracting and retaining talent in competitive market. They act as a reward for performance and loyalty. They work as a deferred compensation plan. Employee stays longer because value builds up over time. They create a sense of ownership and alignment with the organization goals. And especially in startups, they are often used to attract talents when cash salaries can't always match the markets. So, in short, ESOPs aren't just about a pay, they are a tool for building a culture of ownerships and a long-term growth. With that foundation, let's move on to the technical side where most of the pitfall occurs.